Fundsupermart, your online gateway to unit trusts.
Thank you, Adam. Our next speaker is Mr. Benny Gay, Assistant Vice President for Intermediary Sales, Southeast Asia at Deutsche Asset Wealth Management. Benny joins Deutsche in 2014, covering the intermediary sales channels. He manages segments such as the private and consumer banks, as well as the independent financial advisors and life insurers. Benny will be sharing with us today a flexible multi-asset strategy that can potentially be an excellent addition to your portfolios. Ladies and gentlemen, Mr. Benny Gay.
Good morning, and thank you very much for joining us on a Saturday morning. I really appreciate it, and I'm very, very happy to be back here again this year. Just a show of hands, who was here last year? Which of you thought when I talked about volatility in January going to be the main theme in 2015, you thought I was crazy? Well, at least this year the markets are helping me a little because we had a whirlwind of a start of the year. So today, the event is called What and Where, the two most asked questions since this morning, followed by how and when. And what I will be speaking about is which egg and which basket. We've all heard about don't put all your eggs into one basket. But in these days, these markets, which eggs do we want to buy? And more importantly, which eggs do we want to put into which basket? And how possibly we can turn volatility into opportunities. So it's been really, really hard to pin down the asset classes or markets of late. What I like to do is to share our CIOs views for 2016, investors' key concerns, and of course, a possible solution. So let's move on to my CIO's view. As you can see, my CIO is a man of few words. He always likes pictures, but we do have a little bit to elaborate on. So let's start. Growth. We think global recovery is on track, despite mixed data from the US. Of course, last night we saw the markets coming off again because of mixed data from the US in December. And also at the same time, there's so much news that's going on that's impeding growth, impeding us in making a decision on what and where to invest in. For inflation, we think the peak of deflation fears are behind us, and inflation is going to start picking up. However, we need to look at inflation through income and spending, and that's not going to be too strong. Monetary policy remains loose because of the geographic divergence. The US, after many, many months of talking about raising interest rates, has finally decided to do so last December. On the other hand, Japan and Europe remains relatively loose in their monetary policy. So this divergence is also one of the triggers to volatility in the equity or investment markets. Bonds, we think the party is not over yet, but we just need to dig deeper. We need to start looking at credit ratings that we've not looked at before in order to maintain the yield that we want to have. So for bonds-wise, we all know that interest rates are starting to move up. However, we don't think interest rates are going to be too aggressive in terms of the hike, but we need to dig deeper to maintain the yield. Equities. We're strategically positive and tactically careful. My German colleagues sent me last week a picture of a bull with sharp horns, but had 2 tennis balls on it. I took about a day and a half to figure out what they were trying to say. I wish I had a picture, but I didn't get this on the presentation. It means we like the bull market. We think there is going to be a bull market. We are positive equities. However, horns are sharp. We want to be a bit more careful. We want to be defensive. That's why we put 2 tennis balls on top of the horns to protect ourselves from getting pierced, right? So we like equities. We like the more defensive equities. We like equities with dividend income because they are now the proxy to fixed income. And also at the same time, we think that currencies, US dollar still has a bit of way to go. As you can see in the last couple of days, US dollars has appreciated against most of major currencies, except the euro and possibly the yen. Real estate, something that gets everyone's heads up. But in this instance, we're really talking about real estate as an asset class. It's good for diversification, and because of the relative illiquidity of this asset class, there is still some premium in the carry. Hedge funds. Over at Deutsche Asset Management, we have active funds, which are our long-only funds, which is your usual fixed income or equity funds. We also have the alternative funds, which are our hedge funds, real estate funds, and even our global infrastructure funds. So for the hedge fund part, we really think that you need to be able to to benefit from both the long side of the market and then the short side of the market as well. More importantly, being able to benefit from the short side of the market means you protect yourself from downside, but not necessarily mean that you can make lots of money when the rest of your friends and family are losing 5 to 10%, okay? So risk. Generally, we all know that a lot of things can become potentially trigger points in the markets this year. Central banks movement, geopolitics, and of course, valuations. We want to look at and consider valuations, particularly in the US markets, and of course, the other developed markets like Europe or Japan. So, this is my CIO's view for 2016. A few pictures coupled with some words. Now, allow me to have a guess at what all of you are thinking right now. Besides not having a nervous breakdown this early in the year, these are the three things that all of you, I believe, are your investors' key concerns. Number one, how can attractive returns be achieved in a low-yield environment? Two, how can market opportunities be used without being exposed to very high levels of volatility? And of course, lastly, how to build up capital in the long term and in a convenient way. Is it a good guess? Yeah? Okay. I need some response here. Okay. This is a beautiful chart, isn't it? Nice colors, something to cheer us up on a Saturday morning. What we are trying to tell you over here is flexibility is essential in a volatile environment. This chart shows you the top performers, or performance on each year from a top to lowest performance. So as you can see, in 2008, top performer was bonds in the US. 2009, emerging market equities. 2010, another year for emerging market equities. 2011, US bonds again. 2012, European equities. 2013, American equities. And then US equities again in 2014. But what are we trying to show you here? There's no way to pin down a trend in any particular region or asset class. You have to be everywhere and be able to go anywhere to participate in the markets these days. So, require are solutions, right? Investment solutions which invest in broad-based asset classes, are highly flexible, and can actively manage portfolio risk. So, this year, we believe there are three keys to negotiating the market: allocation, selectivity, and of course, diversification. So as you can see, I got this nice picture. I don't know what eggs are those, maybe prehistoric eggs in one basket. A bit counter to what I've said, all eggs in one basket. But if you have a basket that's able to go everywhere and be able to do the correct allocation and select the right asset classes with diversification, this is what we call a multi-asset strategy. And this is our preferred strategy for 2016. So, possible solutions for building up capital in the current market environment. First, we need defensive instruments. What are defensive instruments? Instruments that are not that elastic in market volatility. Things or sectors or services that you use regardless of market conditions. I'll give you an example. Yesterday, China market was down by a couple of percentage. S&P was down 5%. Did you all take a shower? Utilities. Those are defensive sectors. When your markets are down, do you call your financial advisor? Markets are up, your financial advisor calls you. Still, you need telecommunications. Those are also defensive sectors. Number two, you must be able to capture opportunistic themes. For example, I'm sitting down at a coffee shop, I hear someone say, oh, you know what? Someone told me to start looking at Vietnam. What can you do or invest in to get right on that opportunity of Vietnam? Just for example, no such thing, I didn't hear anyone say anything about Vietnam, okay? How do you capture opportunistic themes? What kind of instruments do you use? How can you access those markets? If I said it was a Venezuelan bond market, how are you able to access it? You must be able to capture opportunistic themes. Third, innovative instruments. Long gone are the days where I'm just buying into equities or just bonds. I need to be able to use financial instruments to make it cost-effective, cheap, quick, and flexible. And of course, lastly, the ability to diversify risks. I know diversification and risk is one of the most often heard words, but how do we do that? Of course, I would like to say we leave it to the professionals, but how do the professionals do that? Now, I'd like to take the next few minutes to share with you a little story. So 13 years ago, a very wealthy German family office, so those are families with a lot of money, approached Deutsche Asset Management. They approached our most famous fund manager by the name of Klaus Kauder-Morgan and asked him to manage a sum of 200 million euros for him. What did they want from this? They said they wanted to have this fund in a mutual fund format, and it has to be managed in very, very low cost, but you are free to do anything you want with it. Buy into anything, look at anything, go everywhere, but I just want conservative returns. Okay? So, another condition that they gave us was, this fund must never be marketed to the public. So here we are, in 2016, sorry, a bit. In 2016, and now we're finally able to talk to you about it. The reason is quite simple, because back then, we had a gentleman's agreement with the family office, and that was not to market it to the public. We found out 2 years later it's because they caught wind of a particular tax rule change in Germany that allowed for this money to be tax-free. But thank you to the German office, tax office, 2 years ago, this mutual fund had to be marketed to the public. And so we very, very quickly registered it in an international share class and created all of the necessary share classes in the currencies that were required. But what's most important is this. This was a multi-asset strategy that had a track record of 13 years, performing 7.6% per annum. It's not a very good or impressive performance when you compare it to, say, China markets last year from January to March or April. But what we're talking about is 13 years of getting you 7.6% per annum. But more importantly, we manage the risk at 6.6% per annum. This is even lower than some of the bond funds that are out there in the market. How did we do this? So, these were the main criteria that the German family office gave us. First, you have to be global. Multi-asset fund of fund with a global investment universe. Number two, you must be innovative. We use investment instruments in order to track entire markets rather quickly at relatively low costs. For example, we can use derivatives, or we can use index funds, ETFs. For some of you who have seen me present on ETFs, it's also because we sell ETFs as well. We almost sell everything. Okay, so use ETFs. We are diversified. Broad diversification regarding asset classes, that is, we buy equities, we buy bonds, we go into different industrial sectors and regions. 4, flexible. Equity bond portfolio fraction from 0 to 100%. In fact, in 2014, our equity allocation was at the lowest at 10% and at the highest 70%, all within 1 year. So we are very flexible and we are very quick to allocate to the asset classes that we feel have some opportunities for our investors. And most importantly, the fund feeds into a fundamental-based research. We use extensive research universe at Deutsche Asset Management on more than 1,200 single names, and we also use external investment research to gather input into our investment decisions. But more importantly, how do the managers run this strategy? They live and breathe by these three things. Number one, return orientation. They aim to maximize risk-adjusted returns. What this means is they won't aim to return you 30, 40% in a year. They will aim to maximize the returns that you get based on the risk budget, an amount of risk that the portfolio is willing to take. So the returns will be based on the risk that we take, and it will be no more than that risk budget. Number two, flexibility. This is an unconstrained portfolio allocation. There's no limitation on certain asset classes, regions, or investment styles. And I'll demonstrate that to you later on how we are very flexible. Balanced profile. Overall, we aim to be a traditional balanced fund, but without the limitations of a 60-40 in bonds and equities or 50-50 in bonds and equities. There's no fixed allocation. So this is how we make up our portfolio. First, we use a top-down approach, which is how we feed into our CIO's investment research, and we use that to make up a long-term core portfolio. After that, within the portfolio team itself, there is a bottom-up approach, where we use the views of the team to create more tactical opportunities or allocations within the portfolio. So, remember I spoke about flexibility earlier? This is a beautiful chart where it shows you where we were invested in over the course of its inception since 2004. And as you would see, the most interesting part would be the period of 2008. If you can see from the charts, that's where there is most yellow. And yellow represents the money market holdings, also known as cash equivalents or cash alternatives. In 2008, we were almost 80% cash. And that is what I call flexibility. A lot of funds will tell you they have the flexibility to move into different markets, but having that determination to do so is not widely seen. So as you can see, the fund was very, very aggressive in holding cash in 2008, but we also gradually increased our equities going into 2009. Which then leads me to this chart, our performance over the course since 2002 to 2015. You will see in 2008, we lost almost 12%. It's quite a big amount. I'll still lose sleep over 12%, but still, compare it to other funds, we held our value very, very well, which also led us to do 22% in 2009 because of our increased allocation into equities. But it doesn't really matter to me whether I do 22% or I lose 12%. What is most impressive about this chart is that little blue stroke that goes across. That actually charts the volatility of my portfolio. And all I'm trying to tell you is this: regardless whether I'm losing 11% or earning 22%, my portfolio risk remains between a range of 5 to 8%. And that is how we manage the portfolio, a risk budget, taking an amount of risk that we're comfortable with to maximize returns in any given markets. And this is how we compare to MSCI Europe and MSCI World, our fund, and German bonds fund. This is not a performance chart, so it doesn't mean if you go up, it's very good. This is risk. So the flatter you are, the lower you are, the better, because the less risk you take. So what you will see over here is my multi-asset fund has a risk profile that's similar to German bonds, one of the safest bonds that you can ever buy in this world currently, or fingers crossed. Okay, so what we're trying to achieve here is a low risk profile, and that is akin to that of a traditional balanced fund. I also like to take you through some situations that the fund has been in and how it has performed. Of course, there's the financial crisis, risk aversion, and then China flash crash. In two of those instances, I will just pick on the China flash crash in August. We're not happy that we lost 2.8% when the rest of the market lost 7.9%. But what's more importantly is this: when the market did recover, because of the fact that we did not lose that much, we were able to recover and break even a little quicker. So it's very, very important how a manager manages risk and manages downside. When markets are all up, your returns will naturally come. So again, we maximize Sharpe ratio, which is risk-adjusted returns. These are the return sources, and of course, how we look at risk on a daily basis. In fact, just for your information, we have one guy looking at risk every day, and whenever risk exceeds our budget, we actually have a meeting and decide whether or not we want to continue with that kind of risk in the market. So this is how we have done against the rest of the markets. I won't spend too much time on this. And just to give you a feel of the kind of ride that you'll be in when you buy into this fund, our largest drawdown in 2008, which happens to be in 2008, was 17.71%. When you look at the rest of the other equities, in Europe and world, about 50-odd%. Even currency-wise, we lost about 40%. Gold lost about 37%. So this is how we've performed in the long term. 7.3% per annum since inception. Against our peers, multi-asset peers, 1.9% per annum. Okay, so this is the team. Remember I mentioned about Klaus Kaudermorgen, gentleman on the right over here. He's very, very famous in Europe, Germany, not that well known in Singapore, but he's also known as a Warren Buffett in Germany. So he's been with the company for 30-odd years, and he leads the team of Henning and Christoph. It's a very, very good team with very little key man risk. So this is how he has aged over the years. This is just his awards for multi-asset. He was an equity and bonds manager also. So I'll skip through. These are the share classes that are available to you on Fundsupermart. So remember, we spoke about having the international share classes: Sing Dollar, Aussie, US, monthly distribution, or capitalization. This fund, at the moment, we're targeting a distribution of 6% per annum, paid to you monthly on the Sing Dollar share class. Okay, so thank you very much. My time is up. Happy to take any questions later. Thank you.